Good morning, everybody. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. We're here today for CPI Day. Brought along some friends from Bloomberg Opinion. We have Allison Schrager, author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk, as well as my colleague Karl Smith, former VP for Federal Policy at the Tax Foundation. And like I say, we're here to talk about the inflation numbers. Inflation has been a huge part of the macro narrative over the past couple of years. I put up a decomposition on slide one here of what's been going on, and I think the story continues to be, if there's going to be any stubbornness in the number, it's going to come from this core services category in yellow, which of course includes housing, which is sort of a slow-moving, sort of imputed category. We expect some disinflation, some more disinflation is in train, but of course we'll have to see it in the numbers. I'll give you a quick preview of what the street is expecting. On the month-on-month figure, the median expects 0%, no change on a seasonally adjusted basis. Month-on-month core, the street is looking for a 0.3%, and this sort of breakdown that I put at the bottom, that is core year on year. So you have a bit of a distribution of expectations. And the headline year on year, the street is looking for it to come in at 3.1. 4% on that core for the median. So Allison, I'll kick it over to you. Where are we in the inflation narrative in the United States of America?
Well, I think everyone is sort of really now buying into the soft landing, that we're sort of cruising into this immaculate disinflation, and that, we'll bottom out at 2 and hopefully go back to our pre-pandemic inflation lives, and this was all a bad dream. I don't know if that's true. Maybe it is. I hope so. But I tend to be a pessimist. And that's not based on any number. Well, actually, no, it's based on some numbers. But, who knows? I think inflation has pretty much, say, in the last 15 years, everyone's been wrong at some point.
And you had a great take in Bloomberg Opinion maybe a couple of weeks ago, sort of laying out your pessimistic case on all of this, and a lot of it sort of turned on inflation expectations, and specifically the uncertainty around inflation expectations. Could you lay out that case for us, Allison?
Yeah, so I mean, we know shockingly little about what causes inflation, but one theory is the most compelling one that economists hang on to is it's about expectations. So it becomes self-fulfilling. If you expect inflation, that's what you get. So what we've seen over many, like the last couple of decades of low, stable inflation is everyone were not only expected low inflation, but they were certain about it. So if you looked at inflation expectation surveys, they were not only always around 2, but there was very little variance in that. But now what we're seeing, still very wide variance, and the variance honestly has not changed much in the last year. While inflation went down, the variance is still high, which to me suggests that expectations are not as well anchored as everyone thinks they are. And, if we do get a price shock, everyone might expect inflation to come back, and then that expectation can become self-fulfilling. So I think that's one reason we shouldn't declare victory just yet, or even if we do get to, maybe shouldn't just sort of assume that we've gone back to normal. And, if inflation stays low for another 5 years, maybe we'll get there. But, memories, are hard. And now you have a generation of people who have a memory of inflation, and, it's hard to get rid of that innocence.
All right, fair enough. So about a minute to the number. I wanted to throw up one more slide. We're talking about inflation expectations a little bit. You're mostly talking about consumer inflation expectations, but it's also been sort of instructive to look at the inflation expectations of professionals. This is the consensus median for core CPI versus actual, and you could see for a while there the street was missing pretty wildly in like late 2022, early 2023. They've gotten a little bit better. The street has, but still some work to be done. So here we go into the number. And it comes in at so for the month-on-month headline, 0.1%, up a little bit more than the street was expecting. Street was expecting 0%. On the core month-on-month, bang on 0.3%, and the year-on-year 3.1% versus the expected 3.1%, 4% versus the expected 4%. All told, you have that slight, almost rounding error issue with the headline month-on-month figure, but this is basically as expected. And I'll take a quick look at what's going on over in the bond market to see if anybody is finding a reason to get worked up about this. And I would say that like the reflexive reaction from markets has been a positive one. So you see yields on the 2-year down to about 4.66%. On the day, that ends up being about a 5 basis point drop, although most of that came before the number came out. Okay, so on core we get another 0.3% here. We were talking going into the number, Allison, about how there are still risks here. You laid out your pessimistic view. Does this make you any less pessimistic on the margin, or more of the same for you?
No, I mean, not really. I mean, this is what I expected, and I think we might have another couple months of good inflation reports. I think my pessimism is more structural in nature of the long term, about structural economic forces that might push inflation up, or as I said, this change in expectations, or just sort of a worry about inflation, or risk around inflation that didn't exist before. But I think in the short term, certainly in terms of cyclical reasons, I will expect we'll have another good couple inflation reports, and I think that'll be good for everyone.
All right. Hey, Karl, it is also day one of a Fed meeting, of an FOMC meeting here. Tomorrow, we will get the decision. We'll hear from Jerome Powell at his press conference at 2:30. I wondered, I wonder if you could start by laying out how you think the Fed and inflation have been interacting lately, because you had a really compelling piece not so long ago, essentially arguing that the Fed hasn't really been much of a player here.
Right. I mean, so when we look at inflation overall, what we see is that it's actually the supply side factors that have been the strong player over the last, I say, year or so, dragging inflation down. And I think the New York Fed has a measure of, how much global supply side factors are affecting the CPI. And right now they estimate that it's dragging it down by 1.75% percentage points, so 175 basis points. And so that's a huge fraction of what we've seen, come off of CPI overall. You can kind of see that in the core services sort of, little block that you were looking at before. It's hardly moved at all. We've seen, most of the other action has happened in core goods and, of course, in energy and food. But even inside the core, it's mostly happened inside of core goods. And what we're seeing there is like a sort of inverse of sort of the supply side factors. The other thing is that when we start to think about like, well, what might the Fed have done to bring down inflation? It's hard to pinpoint what exactly it is, because consumer demand has been, continue to stay strong. We haven't seen people sort of pulling back. We haven't seen, especially higher interest rates, really impact heavily, how much, credit card borrowing people are doing, how much auto loan borrowing people are doing. We may be starting to see some of that, a little bit of that in the last month or two, but for most of the last 2 years, we haven't seen that. We've seen consumer demand be robust. We've seen investment, be robust. A lot of that, I think, has to do with the programs coming out of the Biden administration to pull forward investment, to right now. But the fact remains that you might expect higher interest rates to curb the rate of investment, but we haven't seen that. And so if you're not really getting consumer pullback, you're not really getting business pullback in terms of investment. There's not a lot of action there that the Fed has created on the inflation front. And in fact, the place where they've had the most impact is in housing, and that is where they're actually moving against inflation in the sense that housing prices are being driven up by the market being frozen, and the rental supply is slow to come on. And so the rental supply in particular is what's going to impact our direct inflation numbers, and the Fed, whatever impact they seem to have had, you'd have to guess it is slightly negative. And so I mean, I'm not saying that like the higher interest rates aren't going to have any effect, but if you think about the soft landing, it appears to be a lot of it that the heavy supply side factors that we had a year and a half ago have sort of inverted, and they're giving us, I think, an appearance of a softer landing than we're actually experiencing.
Okay. So let me ask you a question related to that, and I'll put it to you too, Allison. But like, so what is the Fed to take away from all of this? Like going forward, should it say, well, I guess next time we get inflation, we shouldn't raise interest rates. Like, let's just sit on our hands and wait for inflation to fix itself via supply chain factors. Like, should they go as far as to assume that, or should they be thinking about this in terms of like, well, this is a very, very unusual cycle. We're probably never going to experience another one like it in our lifetimes. So like, let's just not take any lessons from this at all and try and apply them to future cycles. What do you think, Karl?
So I do think that this is a rare cycle, right? I wouldn't go so far as to say no lessons at all. I mean, so the core, the idea of the core inflation that we have now, mainly is a result of trying to learn the lessons from some of the oil shocks. Now, we don't live in a world where oil shocks are as severe as they were in the 1970s, or I guess the early 1980s, but it was still wise and correct to understand that we have these internationally traded commodities. The Fed doesn't have that much control over it, and overreacting to those price signals is bad. For example, the European Central Bank does, react strongly to, or at least has in the past, reacted strongly to oil prices and food prices, and we think that that's given them a little bit worse performance on monetary policy. And so an acceptance that it may be going forward, especially as we're going through possibly, a deglobalization phase or reglobalization, restructuring and globalization phase, that supply is going to be a really big deal now as we get these chains sort of reworked, as we possibly get broken into two blocks between the U.S. and China. Supply is just going to have lots of volatility over the next couple of years. Probably not as much as the pandemic, but still a significant amount of volatility. And the Fed has got to wonder whether or not it does need to look through much of that. Whether it needs to say, look, all we really have control over here is U.S. spending, and if that hasn't changed that much, then there's not much we can do about where these prices are moving. Now, that being said, I do think U.S. spending is high, and so they are going to have some more work to do. It might come automatically through the fact that effectively real interest rates are rising as inflation goes down. So I don't think that they're actually out of the woods. They do need to do something. But looking forward, I think they have to be sensitive that they're going to be a volatile supply regime, and they're going to have to look through a lot of stuff. So.
You agree, Allison? Like, what would you be taking away from all of this if you're Jay Powell?
I think that's right. I think we're in a very different. We're going into a very. I mean, a lot of people are now saying that the last 30 years, it was very demand driven. So the Fed had a lot of demand driven shocks. So we had the Fed having appeared to have a lot more control over monetary policy. I think another way to think about it is the last 30 years, we've had one big continuous deflationary supply shock in the form of China. So demand shocks were all we noticed because a shock doesn't feel like a shock if it's 30 years long, but it's still a shock. There was that, but I still don't think that means the Fed can just sit on the sidelines. One, a lot of the Fed's power comes from the perception it has power. So if it's just like, hey, hands off, we now have more volatile supply environment, that undermines its power. Also, I mean, first of all, I think Karl's right that we are in a very sort of unusual situation coming out of a pandemic that where maybe monetary policy wasn't as powerful. But we were also in the pandemic in a zero rate environment. So even if you're having supply shocks, like you don't really, particularly an inflationary one, you don't really want monetary policy that's throwing fuel on the fire with zero rates. So in theory, you could argue, okay, the Fed should at least be neutral, but it shouldn't exactly be expansionary in the middle of an inflationary supply shock either. So there's certainly a role for monetary policy, but I think we might have to accept that going forward, it might not be as all powerful as we think, or really wake up to the fact maybe it never really was.
Yeah, I think that's right. I mean, that like I said, I think that, we did have a roar in consumer demand, coming right, out of the pandemic. And the Fed basically allowed that. I think that, much of that was fiscal push, but the Fed, accommodated that fiscal push. And so it still has work to do to get that out. It's just that most of what we've seen over this cycle, I think, has been supply up, and I don't think has appreciated like supply down. There's disinflationary supply side, forces, acting right now. So,
All right. I want to dig into this number real quick, and want to mention the amazing ECAN team at Bloomberg that puts together these decompositions here. But so I put up on the screen, this is U.S. CPI month on month, and this is the decomposition of what's been going on. So no surprise, we were talking about this going into the number in terms of like what is pushing inflation up. It's all about core services in the yellow. What is pulling it down? Well, in a huge way, it was about energy, of course, in November. But you're also getting a drag from core goods, and food was kind of a bit of a non-factor, you might say, in November. So let me drill into this a little bit more. Let's go to let me make this core. So we'll strip out the volatile food and energy components. And so what's still pushing us up? Digging into core services here. Well, the biggest chunk, again, no surprise, still coming from shelter, and you had a reasonably big chunk from medical care services. Again, that ends up being a largely imputed category in the CPI. So you really have to dig in and see what's pushing that around. And then transportation services expanded as a driver of all of this. I did want to dig into one additional piece of this, which is the core goods category. Was interested to see how this was shaking out because it is the holiday season, and I wanted to see how the holiday discounts were impacting different categories of core goods. So this is interesting. Sort of as some folks had been expecting, apparel ends up being a big drag on the number. I'm sort of putting my cursor over apparel. It's sort of in a light orange, but a significant drag on the number, I guess. Allison, we were talking beforehand. We're not sure where to get these discounts exactly, but somebody is discounting apparel in a pretty meaningful fashion. It looks like you're also seeing some pretty decent holiday discounts around household furnishings and supply. There was some narrative that certain retailers, really across categories, were a bit overstocked, and this is a bit of a destocking narrative. Um, I will I will play with this for 1 second. 1 second more. I am always curious about what they call the super core. It's basically core services X housing, and in terms of bespoke cuts of the index, this is one that's become very famous this cycle because Jerome Powell himself mentioned it by name. Although I don't know if does he ever use the term super core? Do you guys know, or did we make that up?
I think we made that up.
All right, all right. Well, credit to whoever coined the term. So Supercore on a month-on-month basis does seemingly tick up a little bit. Transportation services, big driver, and medical care services, big driver. But like, again, just to reiterate, I'm always cautious with medical care services in the CPI because they measure it very differently in the PCE, and the PCE is, of course, the index that the Fed ultimately targets. As they say, the devil's in the details. Do the details give you guys any more comfort, any more anxiety on the margin, or nah?
Well, I think okay. What else?
I guess they give me comfort in that it's what you expect, and expectations being met, I guess, always makes you feel good, especially about things that are so uncertain. But we always have anticipated that service inflation would be a lot slower to go down, especially if we're still seeing vigorous wage growth. This is, I guess on the one hand, you could say not take comfort in that this is going to be a little bit harder to affect with monetary policy or supply, or sort of the continuing good supply shocks we're having. But, on the other hand, it also, we knew this would be coming.
Yeah, the thing I'd say is when I was saying that a lot of what we see happening is on the supply side. What we're thinking about there are global supply chains, things outside the U.S. But the interesting thing here is that, the main stubborn part of domestic inflation is housing, which you could argue, like in our current environment, is a supply side issue. That essentially what we have are, well, I guess there are two big things. I mean, for a while now we've had zoning restrictions that have been that made it difficult to expand housing, especially dense housing in the areas where there was the highest demand, and so that has a strong effect on sort of secular rent growth. But the other thing that we're seeing, recently is a massive shortage in, semi-skilled laborers, right? Carpenters in particular, I think, are extremely short. And so we're having difficulty delivering a lot of the housing, in part because we don't have like the workers to do it. And so you're seeing internationally, supply chains sort of improve, but the housing supply chain in America is stocked up, and like that's where most of the action is, right? So I mean, again, we're seeing that like you can kind of explain what's going on in U.S. inflation without invoking the Fed that much. And I mean, I think that's just interesting. It's almost never like that. I mean, my career in watching that, we felt like the Fed, at least on the margin, was pushing things up and down. Obviously, there was massive secular deflation from China, as we said, but on the margin, the Fed was doing things. But like right now, our margin story, there's just not much room there. We have these things going on with international supply chains, and we have some major problems in the U.S. housing sector, and that's most of our action. So.
Well, I mean, the Fed could I wouldn't recommend it. I mean, they could do what they did during the pandemic and go back and continue to buy every mortgage-backed security on the market to try to bring down spreads. That would be a bad idea, but because then that would bring down housing costs. But like, it's possible. It's just not advisable. Prudent monetary policy would advise against it.
What do you guys think is the most likely scenario through which this unaffordability problem gets rectified at this point? Do wages go up? Do prices come down? Or some combination of the two?
I mean, historically, without some sort of like financial crisis, we've usually seen affordability slowly improve through essentially higher wages and, overall sort of inflation dragging down the real price of housing or shelter costs. I'm guessing that's what will happen now. So nominal wages are still growing at a decent clip, and so you can get some improvement, but that channel is what, like a 5-year channel plus, before you're going to get some real movement on affordability. So that's painful, yeah. But I mean, absent a financial, some sort of crisis, yeah, it's very hard to see like a massive drop, in shelter costs.
Yeah, like to me, what's going on in housing goes back to an age-old debate over whether or not monetary policy should strictly just target prices, or if they should also think about asset prices. And I mean, clearly, I come down on, like, if you open the Pandora's box and start having a central bank that targets asset prices, very, very dangerous situation. You don't want that. But it's like, the problem is basically the price of houses, and the price of houses is not directly feeding into inflation, right? So, like, how should you think about that if you're Jay Powell, Karl and Allison?
Well, I think it's a hairy thing because I think, there's a lot of reasons why house prices or housing's expensive. And I feel bad for people now because they're being hit with a double whammy of high prices and high mortgage rates. Like, at least before you had one or the other. But I mean, to some degree, this is also a monetary policy error where they brought mortgage rates down so low and then had to raise them so fast. So while they're not completely at fault, this is partially, I think, an error on their part. And so I don't know if there's much they can do to rectify it without causing more problems. But, it is sort of, a conundrum for them for sure.
Yeah, and I would say usually when we think about targeting asset prices, we're thinking about putting in some sort of like, put under asset prices. But like this is sort of the opposite, right? So I mean, like, we're trying the houses are like too expensive, and like, what should monetary policy do about that? The hardest thing I think is that, like, in the short term, like, monetary policy makes housing, more difficult, not just like to pay for with mortgages, but to bring to market. Like, higher monetary policy, restricts the amount of houses that come on the market that are built. And if you want sort of a longer term decrease in prices, you want more supply on the market. And so, yeah, how monetary policy interacts with housing is complex. I think, we had a period where monetary policy and housing seemed to be like a great sort of match, for how they were like pulling up and down the economy. The last 20 years, that's sort of like come apart a little bit, and I'm not exactly sure what the solution is, going forward for that. I think mainly from a policy standpoint, we have to think about loosening up some of these supply side restrictions. Always the things to loosen up the zoning restrictions, but also right now we've got to do something about like the number of carpenters, the number of semi-skilled laborers that we have in this country. If immigration is not an answer, then we need to look to something else. But something's got to be done because we're just not able to put the supply out there.
I think that's exactly right. I think we should drop this idea that the Fed is in charge of housing. Like, it is really should be more of a supply side thing. I mean, and traditionally, if monetary policy is done right, it's focusing more on the short end of the yield curve and not buying mortgage-backed securities. And, mortgage rates will be set in sort of a different market that is well connected to monetary policy, not as uniquely tied up in it, and that prices are largely about supply. I think That way, as I said, I think policy errors partially got us here, so we should not repeat those mistakes in the future.
All right. I did, but before we leave everybody, I wanted to have a brief conversation about monetary policy because it is, again, day one of an FOMC meeting, and the market is out there sort of tweaking its expectations of what's going to happen with the Fed. This is futures implied overnight rate and number of implied hikes and cuts, and what it's telling us is that the market now expects roughly even odds, slightly less than even odds, that we will see a cut by March, right? By March of 2024, and I believe it's a little easier to see when I pull up the table. A full hike is priced in by May, the decision coming on May 1st. But yeah, you could also infer that as soon as March, like people are basically seeing this as a coin flip. Do you think that the market is getting ahead of its skis here?
Yeah. Yes.
All right.
I mean,
unpack that for me.
well, first of all, inflation is still higher than target. And also, I mean, monetary policy, I don't know if I'd even qualify as overly contractionary right now. The real funds rate is what, like 2.5%? I don't know if I would call that super contractionary. And considering inflation is still, I mean, depending on what measure you use, maybe 100 basis points above target, why would they be cutting rates in a couple months?
Well, how much?
Well, I mean, they would say, I think they would say simply like inflation keeps coming in, and so there's this passive tightening that's going on in terms of the real rate is expanding as inflation comes down, and they think we have this chance to pull off the soft landing, but we've got to get off the economy's back before it's too late. I'm just playing devil's advocate here.
Yeah, but that is it. I think that lives in a world where they think we're in a super contractionary mode, and I'm not convinced that we are. Sorry, go ahead, Karl.
Oh, I was going to ask John, how much of that is still, lingering worries about, a recession coming in? I mean, even if you think that, I think almost everyone has gotten off that train, but like just, there's still, still some believers, and maybe they're thinking that, that's when the Fed is going to realize that they've over tightened. That to me is the main justification, because where they are right now, yes, there'll be passive tightening, but given that we're a little bit above target, given that there are a lot of supply side factors, you'd think that this is precisely where you want to coast, right? This is, just let that passive tightening happen, and let these numbers keep going towards their target, and moving in with a cut would seem to be counter to that. And so I have to think that you believe that early 2024 we're going to realize that actually the economy tipped over in 2023. I think that's your main case, for a cut. And then maybe in that scenario, they're big cuts, and so you average that out, and you get a little cut in March. So.
Yeah, that is absolutely fair. Recession probability surveys of economists and so forth have come down a little bit recently, but you would still say that they're extremely elevated compared to like normal, and so some of that must reflect a certain portion of the market's expectation that that a recession is coming. I do give a quick market update as we begin to wrap up here. So the market has interestingly reversed a little bit. I'm going by the 2-year, and so the 2-year, which was down as much as wait for it. It was down as much as like 8 basis points on the day, and it is now, as we speak, up about 3 basis points. So who knows what's going on there? maybe as I said, a lot of the gains in bonds actually happened before the number. So I guess as people get into into the weeds on this, they say not quite as good as we were expecting. But so uh, here we are. Heading into Fed Day tomorrow. I have one more question though I wanted to leave you both with, and then we'll wrap up here. We got a summary of economic projections tomorrow. And one of the things that I always think is really fascinating with the summary of economic projections is you can get a sense of where policymakers think R star is, or the real longer run neutral rate of interest. It's sort of implied by what they say about the long run nominal rate, right? So in general, Fed policymakers have been writing down that they think the long run nominal rate is about 2.5%. They also assume that we will ultimately get back to their 2% inflation target, and that implies a long run real rate of about 0.5%. But if you look at things like the survey of primary dealers that the New York Fed does, is sort of Wall Street economists have been actually revising up very slightly their expectations of where that long run neutral is. Do you think we might possibly see a move from Fed policymakers? Are you guys revising up your estimates of where you think that magical number is?
Yeah, I mean, I think for a lot of the reasons Karl's been sort of describing this whole time, I think there's reasons to think that we might be in a structurally different environment where interest rates are higher. For I said a lot of the reasons he's described already, and also you could argue demographics and all of these things. And maybe we're not going back to zero R star anytime soon.
Yeah, I think I would say 6 months ago, I can't remember. I was skeptical about R star raising. As things have played out, and especially as I think the reglobalization story, as I'll call it, is happening. Like Allison saying, that actually is having me pull up my estimate. Just because I think there are going to be so many supply challenges like going forward. I think that we're going to be in a world where that deflationary force and that interest rate pulling down force that came from China and Asia in general is probably not going to be there. We're probably going to be in a block that is like more industrialized, probably going to have higher interest rates overall. So